All right, let's jump right in. Today, Friday, February 27th, was a real head scratcher in the Asian markets. I mean, we saw some seriously conflicting signals, and we're going to unpack exactly what went down.
So here's the big question, right? Why did the markets move this way today? You've got Korea's main index falling while its smaller one actually went up. And then, out of nowhere, China and Hong Kong rally. What is going on? Well, that's exactly what this explainer is for. We're going to play detective and figure this thing out.
Okay, so before we can solve any mystery, we need to look at the evidence. We have to start with the what before we can get to the why. So let's lay out the raw numbers from today, the very data that makes this whole situation so confusing.
And right away, you can see the problem. I mean, the divergence is just crystal clear. Take a look at the KSPI, Korea's big main index. It's down a whole percent. But then you look at its smaller cousin, the KOSDA, and it's in the green. And then jump over to Hong Kong, where the Hang Seng rallied almost a full percent. It's like these markets are living on different planets today.
So, our first stop is South Korea. This is really where the market felt like it had a split personality today. I mean, you've got the two main indexes going in completely different directions. Let's break that down. Yeah, so on one hand, you've got the KSPI. That's the big one, the index with Korea's largest companies, and it dropped a full percent. And the reason why is pretty straightforward. Investors were taking profits. I mean, after the huge run-up we've seen, giants like Samsung Electronics and SK Hynix were just ripe for a little profit-taking.
But at the same time, you've got the KOSD, which is home to the smaller companies, and it actually went up. So what's fueling that? Well, it's a massive surge in retail investor activity. This thing called BITO, which is basically debt-fueled investing, has hit an all-time high. We're talking margin loan balances soaring past 40.8 trillion won. That is a ton of money.
So how do we make sense of this split? Well, there's this interesting idea called social mood theory. And it basically says that market moves aren't just about fundamentals. They're driven by the collective mood of the public, optimism or pessimism. And what this theory suggests is that the KOSPI's recent record-breaking run was fueled by just this extreme, almost euphoric optimism. And whenever you hit that kind of peak, a cool down, a day like today, is pretty much inevitable.
And this really breaks it all down, doesn't it? First, you had the so-called smart money, the big institutional and foreign investors saying, whoa, these big stocks are getting a little pricey, and they started selling. The technicals backed them up, with the RSI hitting a wild 86.6. I mean, that's deep in the overbought zone. So what happens to all that cash? It flows right into the smaller, less inflated stocks on the KOSDAQ. It's like selling your expensive brand name stuff to buy something just as good, but more affordable.
All right, let's switch gears and head over to Greater China. Now, the mystery here is the complete opposite of what we saw in Korea. We're talking about markets that have just been hammered for weeks, and then suddenly today, they spring back to life. So the big question is, why now? Wow, this chart really tells the whole story, doesn't it? I mean, look at that. Hong Kong's tech index got absolutely crushed this month, down a painful 10%. And yet today, it managed to pull off a solid rebound. It's a classic case of deep, deep pessimism finally hitting a bottom and finding a tiny spark of hope.
So what's the logic behind a rebound like this? A really key concept here is mean reversion. It's a fancy term for a simple idea. Things tend to go back to their average. Think of it like a rubber band. If you stretch it way, way too far in one direction, in this case down, it's eventually going to snap back. The further it's stretched, the more powerful that snapback can be.
And it really was a kind of perfect storm for a rally. You had a few things happening at once. First, the market was extremely oversold. The RSI was down at 23.7, which is just rock bottom. Second, you had bargain hunters jumping in. I mean, when giants like Tencent hit 5-year lows, people start to notice. And finally, there was a little bit of hope on the horizon, with everyone looking ahead to China's big government meetings, hoping for some pro-growth policies. All right, so we've dissected what happened today. We've got our theories. Now let's do something really cool and turn to our quantitative models. We're going to get a data-driven forecast for where these markets might be headed next month, in March. So our models run, get this, over 100,000 simulations to figure out the most likely path forward. And you can see the results right here. The forecast suggests Korea's upward trend is likely to continue. But the real showstopper here is Hong Kong's tech sector. The model is projecting a potential rebound of 8 to even 9%. That's huge.
Now, for Korea, this positive outlook isn't just wishful thinking. It's actually driven by some massive institutional changes that are on the horizon. We're talking about a plan to internationalize the Korean won and a very high chance of being upgraded to the MSCI World Index. What does that mean? It means a flood of global capital could be forced to flow into that market.
And for Hong Kong and China? Well, the forecast is all about that powerful rebound potential. It's a mix of three things: expected pro-growth policies from Beijing, that sheer mathematical pressure from mean reversion we mentioned earlier, and just the simple idea that maybe, just maybe, the panic selling is finally over. The sellers are just exhausted.
So the big question is, how do you actually navigate a market like this? Now, I have to be clear, this is not financial advice, but what we can do is use this analysis to build a systematic, rules-based framework, a sort of playbook for managing risk and making decisions when things get this choppy.
So, based on everything we've looked at, a model portfolio could look something like this. You see a heavy weight on Korea's large-cap stocks to ride that institutional wave. Then, a pretty significant bet on that Hong Kong tech rebound. You sprinkle in some exposure to the smaller Korean market, and, this is really important, you keep a 15% cash buffer. That's your safety net and your dry powder for new opportunities.
Okay, let's talk strategy. Strategy A is for the KOSPI, and it's all about using volatility to your advantage. The rules here are super clear. Number one, you don't chase a rally. You wait for a dip, a pullback to a specific level. Number two, when the market gets hot again, you take some profits off the table. And number three, and this is the most important, you have a hard stop loss, a non-negotiable exit point if the trade goes against you.
Now, strategy B is designed specifically to capture that potential rebound in Hong Kong tech. The trigger to get in is a technical signal when the RSI starts to climb out of that oversold basement, suggesting the worst might be over. From there, you aim to ride the trend up towards our model's target. But just like before, you have a clear line in the sand, a hard stop if the rebound fizzles out.
Look, at the end of the day, whether you use these exact rules or come up with your own, the core idea is the same. This is the big takeaway. In a market that's driven by both cold, hard data and wild human emotions, trying to navigate it without a plan, without a system, well, it's like sailing in a storm without a compass. You're just leaving everything up to chance. And that just about wraps up our investigation for today. We've picked apart the mystery of these mixed signals and looked at what a data-driven path forward might look like. And it really just leaves us with one final question for you to think about. As you face the inevitable volatility ahead, is your system ready?